Well, good afternoon. It's a pleasure to be here and introduce you to Contango ore. Can you guys all hear me? I'll try to remember to speak into the mic here. I understand it's a bit noisy outside. I'll be making some forward-looking statements, of course. As we just said, we're developing a number of gold mines in Alaska. We're in production with our first gold mine called Manh Choh. It's a joint venture with Kinross, and the short story there was we found the deposit, roughly 1 million ounces, very high grade, 8 grams open pit. And rather than build our own mill and tailings facility, which would have taken a long time and cost a lot of money, we decided to take advantage of their existing mill capacity at their Fort Knox operation. So we did a joint venture with them on a 70-30 basis. We own 30%. The mine produces about 200,000 ounces of gold a year. Our 30% share is about 60,000 ounces. And that generates over $100 million of free cash flow at today's gold prices. We've done that in a very quick amount of time and not had to spend a lot of money on capital. We want to do the exact same thing with our Lucky Shot mine, which is now basically we're in the process of working on a feasibility study to produce 40 to 50,000 ounces of gold a year. And then a couple of years behind that, we'll have our Johnson Tract project. So I'll explain our plan and just a quick introduction on our share capital structure. We're also a bit unique in that we only have 15.5 million shares outstanding. We're cash flowing over $100 million a year. Our debt's down to under $15 million now with the announcement, today's financial statements that just actually went out today. Actually, a bad day to make financial arrangements when the gold price goes down $100. We can see we've got a strong shareholder base and a lot of coverage from analyst coverage there. So you can take a look at that in our corporate presentation. Very importantly, management owns 20% of the company, and so we are very much aligned with shareholders. We want to deliver our growth plan, our 3X growth plan, without diluting shareholders. And when you look at our cash position of over $100 million today, and our annual cash flow of over $100 million, we are in a position where we can say that we can achieve our growth plan without diluting shareholders. So our growth plan starts with Manh Choh in production, producing 60,000 ounces of gold a year. 2 years from now, we'll have our Lucky Shot project in production, producing 40 to 50,000 ounces. And then 2 years beyond that, we'll look to get our Johnson Tract project into production. And that doubles our size in terms of production, because Johnson Tract is a very large project and very good grade in comparison to the other two. How we do this is through what we call our direct shipping ore model. Basically, it's putting rocks in a box and transporting them to an existing milling facility. And what this does, it results in a very small footprint that we have to permit, because all we're permitting is basically a quarry. Whether it's an open pit quarry or an underground quarry, it's a very small footprint to permit. We're not building a mill, we're not building a tailings facility, we're not building a big power plant to run all that. That makes it simple to permit. That also obviously reduces our capital needs, because we don't have to pay for a mill and a tailings facility and a power plant. So that's how we're able to do this without diluting you as shareholders. Most other companies are telling you, look, I'm going to find 5 or 10 million ounces of gold and Agnico Eagle is going to buy me. That happens about 1 out of every 500 companies. There's 3,000 companies in the Canadian and Australian markets, and so you got to pick the right one. We're starting with cash flow, and we're going to build our cash flow by producing more gold using this DSO model. So we'll start with Manh Choh. It's located on lands owned by the Tetlin tribe, not too far from the Canadian border, just outside of a town called Tok. There's 150 people in the tribe. They have a 3% royalty on a mine that produces 200,000 ounces of gold a year. This year they'll make about $21 million in their royalty payments. They're very happy. About half of that goes into a permanent fund that they're investing for the long term. Half of the other half goes to a distribution to their shareholders, and the rest goes to the community for community development. It's been a great reward for them and us to see that realized. We started with a joint venture with Kinross in the end of 2020, so call it 2021. Within 2 years, we were in production, in a mining operation, and then a year later, as we built up the stockpiles at the Fort Knox mill, then we got into production in mid-July of 2024, last year. So we've been in production over a year now, and we like this model. You mine at site, you put ore in a truck, you haul it up the highway 400 kilometers to the Fort Knox mill. In rough numbers, that costs us about 1 gram to do that. We've got 8 grams as our head grade to work with, so we got 7 more grams to make money with. You can see that at the half year, we were well ahead of our guidance of 60,000 ounces of production and lower cash costs than we had guided at $16.25 for all-in sustaining costs. In order to get this mine in production, we did have to borrow some money from the banks, and bankers are more conservative than mining companies, and 3 years ago, everybody was using a $1,400 gold price. The mining companies were using a $1,400 gold price. That means the bankers wanted us to hedge to protect against a $1,200 gold price. So we've been, the last year and a half, we've put all of our efforts into paying down the debt. The $60 million of debt is now down to 15, and we've been delivering the hedges, and we started with 124,000 ounces hedged, and now by the end of the year, we'll be down to about 40. We want to get unhedged. It wasn't our plan to hedge gold. We were coerced, I guess, by our friendly bankers. We are on track to exceed our production in terms of ounces produced, our share of ounces produced, and we're on track to be well below our 1625 guidance, probably in the mid 1500 level for all-in sustaining costs. This is, to me, the most important slide in any investor deck, because if you're an investor in gold, you want to be exposed to cash flow from gold. We are more like a royalty company. In fact, we call ourselves a hybrid royalty company. We have 10 people in the company right now that manage our projects, and we're generating over $100 million of free cash flow. This slide was done at $2,800 gold. We'll have to get the bankers to adjust this. But the point is, the only other companies that really compare to us in terms of cash flow per share are the royalty companies. Again, remember, we've only got a little over 15 million shares outstanding. So we like this model. What does the DSO model require? You got to have grade. We're not dealing with 1 gram gold deposits. You got to be near existing infrastructure. If you're not near infrastructure, you have to build your own infrastructure. That costs money, and it takes a long time to permit. And from a permitting standpoint, we love working on private land because that makes permitting a lot easier. The public doesn't get a say of whether or not mining is the appropriate use of that land. The landowner gets to say. In our case at Tetlin, or at Manh Choh, it's the tribe, the Tetlin tribe. In the other 2 cases, we basically look working with Alaska Native Corporations. So I'll go through those. Oops, there we go. So on to Lucky Shot, second project we plan to get in production. It's a small resource right now. We just got finished doing all the underground work and doing some drilling, 110,000 ounces at 14 grams per ton. The important number is the 14 grams per ton. We'll grow the resource. I'll show you how. It's near infrastructure. So it's got grade, it's near infrastructure. It's a 2-hour drive from Anchorage, Alaska's largest city, on a state-maintained road. Here's what it looks like. It was a mine that was in production between 1928 and 1942. At that time, President Roosevelt used the War Act to shut down all gold mining in the United States. He actually made it illegal to own gold in the United States. But the point is, it was shut down administratively, not because it ran out of ore. It ran into some geologic problem underground. It was just shut down administratively. So the Lucky Shot 500 level there, they mined 250,000 ounces of gold at 40 grams per ton. Now that's an ounce and a quarter per ton. That's very high grade. Now we're not going to mine it the same way. The way they mined it was not safe by today's standards. We're mining on a cut and fill basis a 3-meter average mining width. So all the vein structures that we hit, we dilute down to a 3-meter mining width. And those average 14 grams per ton as a resource grade. We're going to come in underneath this, the tunnel there. You can see the end search tunnel. That's our infrastructure underneath the existing old mine workings, which you can see in this 3D cutaway here. The light gray stope map there, that shows where the historic mining took place. And basically, we put the underground infrastructure in place underneath that underground to do all the drilling. Basically, we call it fan shot drilling. You're drilling from underground from near vertical to a -10, -20 degrees to drill the vein out. You're very close space drilling. The fan holes are about 15 meters apart, and then every section's about, you're drilling about every 25 meters. So it's about 15,000 meters of drilling. We got a little bit more work to do on the Coleman side, which is the same vein, just slightly offset with a fault. We want to drill it down so that we can access it from the Lucky Shot level. This is all work that we can do. We're funded for it. We've got over $100 million in the bank right now. So it's 15,000 meters of drilling. It's going to cost about $25 million to do that and take about a year. Once we do that, we do a mine plan, and then we put the stopes in place. That'll cost about another $25 million. And then we're mining. We're basically putting rocks in a box, putting them on a truck, haul it down to the railroad. The railroad can go up to the Fort Knox mill, or alternatively, we can go south and go to the port at Stewart and transship this material over to a smelter in Taiwan that would really like to have it. So we've got some choices there to go through. Next up is Johnson Tract. This is a wonderful asset we acquired last year. It's a little over 1 million ounces at 9.4 grams gold equivalent. It's it's gold, silver. They accept about 75% of the value, and then the base metals, copper, lead, and zinc, which are now called critical metals, make up the other 25-30% of the value. It's on land owned by an Alaska Native corporation, Cook Inlet Regional Link. You'll notice that it's inside of a national park. We are not crazy. Their land rights pre-exist the existence of the park, so they have special easement rights that have already been granted. We wouldn't have done this project if they had not had that. But those easements, right-of-way agreements with the federal government have already been issued. So we simply have to design a road that minimizes impacts to wetlands and make sure the fish can go from one side of the road to the other, which is all very technically doable. The mine site itself is on the patented ground. We've been working with the state for the last year here to get permits in place so we can start building the tunnel. The road is already permitted. You can see the camp in the foreground, the big mountain in the middle there. The deposit's located between the big mountain in the middle ground and the one behind it, which makes it very difficult to continue to drill from the surface, which is why we want to put the underground in to continue the exploration effort to complete a feasibility study. But it also will, like Lucky Shot, it'll serve as our main access to when we want to go to a mine development decision. So next year's plan is to get the road built, the tunnel, the equipment to build the tunnel in place, and a winterized camp. That way we can work year round. That'll cost about $20 million. This is what the ore looks like. It is absolutely beautiful ore. It's a breccia. You can see the grades and the thicknesses there. The average of the ore body here is about 40 meters wide. So it's almost the opposite of Lucky Shot. Lucky Shot's high grade and narrow. This is fat and also really good grade. So this is a beautiful mine. It is completely open at depth. We just ran out of room on the mountain to be able to place drill rigs in the right spot to drill it. So once we get underground, the yellow blocks here are 3 grams, so the hotter the color, the higher the grade. The fuchsia color there, that's 25 grams per ton. So this is a very, very nice ore body. It's open at depth. The length of the tunnel is about the same as we did for Lucky Shot. So this is a kind of a scale kind of a project that we've already done before. The length of the road to connect to the coast is about 15 miles or about 22 kilometers. So again, that's about the same length of road that we built from Bancho. So it's just, these are scale projects that are, they're not 10 times bigger than we've done before. Mine plan. We issued a initial assessment. If you're used to Canadian parlance, that's a PEA. US calls it an initial assessment. Basically $220 million, $25 million of capital to get this thing into production. 50 of that is to do the feasibility study. So 50 is basically for the tunnel and all the drilling to complete a feasibility level mine plan. which will get underway next year, as I mentioned. You can see the very low all-in sustaining costs for this project. And that's just because it's such a good high-grade ore body, and its average is 40 meters wide. We plan to get this underway, as I said, next year. But it does take time to get all the work done. So we've got to do a year's worth of work to get the tunnel in, a year's worth of work to get the drilling done, another 6 months to get the feasibility study completed. And while we're doing all that, we're permitting the access road down to the coast and the barge landing site. So same story, rocks in a box. This time they go on a barge. And the barge goes to probably not Fort Knox, but probably a mill that we're looking at either making an arrangement to toll for us, or we're actually in discussions to buy a mill. So that would be our preference, because then we can combine our DSO model with a hub and spoke approach where the mill is the hub, and you find other projects like Johnson Tract, like Lucky Shot, that can be fed to your mill. So that's our growth strategy. 5 years. We're almost finished up with year one, so 2 more years we get Lucky Shot into production. 2 more years after that we get Johnson Tract into production. If I've got time for questions, I'm happy to do that. Otherwise, I'm around. Bonnie Broman is here, our corporate communications person, and Mike, my CFO, Mike Clark, my CFO. I don't see him, but he's out there too. So track one of us down. Happy to answer any questions for you. Thank you.